keyman insurance is taken out on the lives of individuals that play important key role within the business.
Okay.
But buy and sell agreements is for shareholders.
Shareholders.
Right.
Wow.
So that is the difference between the two.
No, we are all learning. We are all learning, guys, as you can see. Yeah, so I think we've now reached our third segment or third part of, I think the financial conversation. That's what I'll call it. And before we close off, I think now we're just going to touch a bit on, some parts of insurance, some parts of provident fund and so forth. So yeah, I think, my brother, the first question then I can put forth to you. I know that, we hear about all of these terms, pension fund, provident fund, retirement annuity, but is there a difference? What are they, and what are they basically set up for?
Okay. So there's also one called pension preservation fund, preservation funds, right?
Okay.
And it can either be pension preservation fund or provident preservation fund. But essentially what these funds are retirement funds, that are governed by the PFA, which is the Pension Funds Act. And what they're used for is, for retirement savings, right? And when we look at pension funds and provident funds, they are what we call employer schemes. And essentially what that means is that there has to be a relationship between an employer and employee. So the employer sets it up, and once you sign a contract with an employer, then automatically you have a pension or provident fund, depending on what the employer has set up, right? And when we're looking at retirement annuities, is what we call private schemes, and there is no employer-employee relationship. It's the relationship between the financial service provider and the client. Right. So, for example, with the pension fund, you can't now go to the government's employee pension fund and say that, look, can I take out this retirement fund? And the reason why you can't is because you're not a government employee, right? So only because of conditions of employment then do you qualify for to belong to the GEPF, right? So if you're not working for the government. You can't be a part of that, and that's what we mean by employer schemes. Now, if we can look at the differences between the three. With regards to the pension fund and the provident fund, prior to the 1st of March 2021, there was a difference in how they paid out at time of retirement. So the provident fund would then when you reach retirement age, would pay out your total retirement savings as a lump sum. Right. So after tax, you'll receive a lump sum. And the pension fund, at time of retirement, you could only get 1/3 as a lump sum, and 2/3 you'd have to buy an income, which is what we call an annuity. And which works the same with a retirement annuity. Once the value or the fund value of your retirement annuity is over 247,500 rand, then you'll have to take 1/3 as a lump sum and 2/3 as an annuity. You'll have to buy an income. But post the 1st of March 2021, essentially what happened is that the same rules that applied to a pension fund now apply to a provident fund. So now there is no difference between a pension or a provident fund, because essentially they pay out the same. So in the past, what employers would do is that they'd pay out. They'd have both provident and pension fund, because they know that the employer, once they retire, they'll get a lump sum, as well as they'll have a portion where they can buy an income. But now both of them work the same. So what employers are doing now, they're amalgamating their pension funds into one, either a provident or a pension fund, right? Because of the administration costs. But there are certain employers who can't afford to start a pension fund or provident fund for their employees, and that's where now people need to look at options like retirement annuity. Because then retirement annuity, you can then now sit down, look at your budget, what you can afford, and start contributing. And it's very important that people have these things, because at the end of the day, you're not going to work forever. There has to be some point where you retire, and whatever you've saved over your working life is what's going to sustain you. So that's why these products are important. And just to touch on the preservation fund. Now, how the preservation fund, which is one that people don't necessarily know, let me give you an example. Let's say you were working at a company, you had a pension fund, and now you resign or you got a new job. Now you are at that one company, and you accumulated, let's say, 100,000 in retirement savings. So what people tend to do is that they tend to cash out that retirement saving, right? Because maybe they don't necessarily know, the other options they have, and then you get taxed on that, right? The tax is high. But what you could do is that you could take those funds and transfer it to a preservation fund, and that transfer is tax-free, so you won't be taxed. And then you could leave that money to grow over time, and then you can access it at time of retirement, because people have this tendency of start-stop when it comes to their retirement planning, right? So you work at a job, you accumulate, you retire, take that money, use it. Work at another job, and what happens is that's why we have 91% of South Africans that say that they are not comfortable or they're not confident in their retirement provisions.
91%.
Yeah,
That's
and
incredible.
from that 91%, 50% have acknowledged that they'd have to continue working after retirement. So you can understand that retirement savings is something that people don't take seriously, because we always have this mindset that I'll see it later, or I'm not going to live for that long.
Eesh.
So yeah.
Wow. Okay. And I mean, so it's something similar, but now we've talked about, I would assume the employee. You've mentioned provident and, pension funds, relationship between employee and employer. Retirement annuity is more of a private thing that you do with a financial advisor or financial planner. Now, when you have a business, you are, the business essentially is your lifeline, in a sense that it's the one that, helps you make your money, in as much as, yes, you pay yourself a salary, but sometimes you don't even pay yourself a salary that's enough to even live the lifestyle that you want. So is there such a way that you can also make sure that your business in itself is insured? Because I think we've talked about insurance, or we maybe yet still going to talk about insurance products, but I don't think, in general knowledge and general public, we talk enough about business insurance, what it is and how it helps the entrepreneur, the business owner. So I think, can you just maybe give us a few of your thoughts on that?
So when we look at business insurance, what business insurance wants to do, it wants to protect, succession of a business should the director, the founder of the business pass away, right? So essentially, when we look at business insurance, there's what we call buy and sell agreements, right? So let's give an example. Let's say you and I, start a business, right? And you have 50% shareholding, I have 50% shareholding. You and I share the same vision and mission statement with regards to what we're trying to build, which is the business, right? And now, what happens when you pass away? What do you think would happen?
I mean, so it would lead on to the next part of the conversation or the question. But I think if I've passed away and I don't have a will or a trust set up, essentially those 50% shares will probably be dissolved back into the entity, which essentially will come back to you, and then you'll probably own 100%. That's what I think would happen if there aren't provisions made. So if there's no will, there's no trust, we have allocated probably a percentage of, if there's nothing of that sort, then I'd assume that it goes back into the company, and then you would essentially then retain the 100% of the company.
So that's not what happens, right? So when we're looking at shares or shareholding in a company, they are also considered assets, right?
Okay.
And if you own those assets, it means that if you pass away, they fall into your estate.
Okay.
Right? So if it falls into your estate, then your beneficiaries, whether you have a will or you don't have a will then inherit that, right?
Okay.
But the problem that does is that it creates succession issues, because when we're looking at the stats, 90 to 95% of small businesses close down after between 12 and 24 months of the death of the founder or shareholder.
Yeah.
And the reason why is that, so back to my example, you and I start a business, I have 50%, you have 50%. And when you pass away, you have a son. Now, your son has a different vision or mission statement with regards to how he views life, right? And because he has shareholding, because your shares went into your estate, then what happens is that he owns part of the business and he can start making decisions, right? And what happens is that it causes operational
Out of
conflicts. It causes operational conflicts. Why? Because he comes saying, no, I own 50% of this. And fair, he does, because of you were his dad. Maybe you left it to him or it went to your estate, and because he was your son, he will earn. So it causes a succession problem. Now, when we're looking at insurance with regards to business insurance, buy and sell agreements, when we take out buy and sell agreements, it obligates you to sell me your shares when you pass away, and me to buy your shares when you pass away. And what that does is that it controls succession of the business, because now I can continue the business with the vision and mission we had. Right? There won't be any, external force coming into the business. Right? And then, so what happens is that the shareholding that you owned that I purchased with the insurance will then now be paid out to your beneficiaries. Now there is no succession problem, because what happens is that with beneficiaries, let's say you don't have a will and it pays into your estate. Do you know how long it takes to unwind an estate?
I mean, I don't, but I listen. We've lived long enough to know that those things take even probably sometimes even years.
So it can take years. And now if your son owns shares in the business, you can't make decisions within the business up until the estate is wounded up. Why? Because the shareholding is in the estate. So that becomes a problem. So small businesses, where when you have partnerships, it's very essential that you take out a buy and sell agreement to protect the succession of the business, to protect the vision and mission that we had when we established this business.
And I mean, maybe the same example that you just made, right? On the top of my head, I just thought about it now. I've heard this term before, keyman's insurance. I don't know now, is it a similar thing that you just explained, or is that something entirely different? But I know that it only works, or most of the time it works when you have a business partner. Yeah.
So keyman insurance is totally different.
Okay.
So buy and sell agreements work with regards to shareholders within the company.
Okay.
Right. So you take out a policy on me, and I take a policy out on you.
Is that now keyman's insurance?
That's buy and sell.
Buy and sell.
Right.
Okay.
Now keyman has to do with, is there a key individual in this business who, if they were to pass away, we would experience financial losses.
Okay.
So it can be an employee or a partner, right?
Okay.
The mere fact that that person plays a very integral role within the business ensures that you can take out insurance on them, right? So what happens is that, let's say for example you have let's say you have an employee, and you know that within the business this employee, their value is worth 2 million, right? Because this employee deals with the back office, they deal with the clients. So now, if this person passes away, then it means that the functionality that that person brought won't be there anymore. Now think about it this way. Now you have to do interviews. You have to get a new person. You have to teach them the system. Within that period, what's happening to, the functions of the business. Right, so keyman insurance is taken out on the lives of individuals that play important key role within the business.
Okay.
But buy and sell agreements is for shareholders. Right. Wow. So that is the difference between the two.
No, we are all learning. We are all learning, guys, as you can see. No, that's fantastic. And I mean, I've never thought of it, myself. I mean, I have a business partner, Tebogo. and then we do everything together. You know, we've also even never thought of like business insurance or keyman's insurance. But I think obviously after this conversation, you know, it has to be something that, you know, myself and him have to also like, you know, consider, even talk about. And I think also just to wrap up, you know, there's about 2 more questions. And I think these 2 questions kind of like, you know, bank on top of each other. We haven't touched on life insurance or life policies. Yeah, so I think for a lot of people, it's like if I have a retirement annuity, if I have a provident fund, if I have a whatever sort of investments that I've set up, why the hell would I need a life insurance?
Insurance is very important, and not necessarily for yourself. I think the problem is that we have a very selfish view of life, right? I hear a lot of people saying that, but I'm dead. They don't need my money. I'm dead. I'm dead. You know, so they don't necessarily see the need of, you know, having life insurance. But if, you know, you have people that you love, if you have a son, a daughter, a wife that you care for, you must understand that should you pass away, if you're married and you're married in community of property, since it's a joint estate, the debt that you owe becomes due immediately. Right. So now, if you don't have life insurance, how do you think that your partner would settle the debt that you had? Right. So now you're left in a position where they're selling off assets that you believed you worked hard for and you left for them. Right. And also, now that you're alive, you know, you're providing for your kids, you're providing for your spouse. And, you know, that income that you're bringing into the household, you know, it's what's, you know, it's supplementing your lifestyle. So now what happens when you pass away and there's no money coming in? Or the money that's coming in is not enough. Now it becomes a problem. So life insurance, you know, aims to, you know, fill that gap. To say that, yes, you have passed away, there is no income coming in anymore. But because you were covered for a certain amount of money, that money can be used to supplement, you know, the income that was there now that you're not there. And that's why it's very important to sit down with someone that can show you the full picture, as to say that, look, this is your income. If you were to pass away, this is what your family would lose out. This is how you can replace that income with this amount of life cover. Then, you know, you're able to make informed decisions. Life cover is very important. I think we need to move out of this, you know, mindset of no, I'm dead, you know, but think about the ones that
You're
we
leaving
love,
behind.
that we leave behind.
And I mean, I just a continuation to that, right? I mean, it's a, you know, fantastic point that you just made. I read somewhere or I saw somewhere that I think even the Rothschilds, you know, apparently one of the richest families in the history, how they've set up their generational wealth was actually through life insurance policies and putting them in a trust or something. I don't know how the whole thing works, but I read somewhere that apparently you can use life insurance as a tool to create generational wealth.
Yeah, you can. It's just a matter of how you're doing it or the mindset in what you're doing. Like I said, we need to move away from the mindset of, you know, the selfish mindset, right? Because if you want to use life cover as a tool for generational wealth, you must understand that you won't benefit from it.
Yeah.
You won't benefit from that wealth. So that's something that's hard for people to, you know, really get into terms with. So how you can essentially do that, or how they've done that, is that if, let's say, for example, you have a family of 5, it's you, your wife, and 3 kids. If you take out a life cover for each one, let's say worth 2 million each, that means that in the family there's 10 million worth of life cover, right? So meaning that if you pass away, that 2 million, then you create a trust and it pays into the trust, right? And that money is going to be put in investment and it's going to grow. Then your wife dies, same thing, 2 million within the trust, no one's going to use it, it's going to grow. Your kids die, same thing, those 2 millions are put back into the trust and they grow. So you guys are not going to see any of that money. And when your kids have kids, they do the same for their kids, which pays into the trust,
Yeah.
and the money grows, right? So that's how it's done. It's not necessarily mathematics. You just need to believe in, not being selfish, and that the money that you're putting away is, for the future generations,
Yeah.
and not for you.
And I think also to your point, I mean, it also only works, if we're being honest, if there's already a system that's kind of been built, in a sense that, yes, your kids, you've taught them how to, multiply the money. You've showed them the means of production. You've given them information and resources, because at the end of the day, that 2 million, if I die and it goes to the kids, he's just gonna go and buy a bloody Porsche.
Exactly.
But if I've set him up to say, no, listen, we have this bakery. The 2 million comes out, you take this bakery, you make it 10, you make it a franchise. That's how you kind of, so I think also that's another way to look at it, in a sense that, yes, you might not be the main beneficiary of that insurance, but it also only works if you've given the people that you've left behind those necessary skills.
And if, let's say, for example, your kid, he doesn't have those skills, but because you've established a trust, which has a trust deed, and the trust deed will stipulate that whatever money is in the funds, because don't forget, you don't automatically, inherit money from a trust. There has to be a trust deed, and the trust deed will then say what should happen with the money that's in the trust.
True.
Right. So if the trust deed says that in order for you to qualify or to inherit or to benefit from this 2 million, you should have a company that you've established, and the revenue of the company should at least be
a certain number.
100,000.
Lovely stuff.
You get what I'm saying? Then essentially the trust deed will then direct how people will end up using the funds.
The funds, yeah.
Right. So trust deed, very important, and how you structure that trust deed, because that's what essentially is going to speak for you when you pass away. Right. So even if the child, doesn't want to, start a business, so essentially it means you're not going to inherit
the funds.
from the funds. Right. So
Giving ideas here.
so there are ways in which you can use a trust, especially with the help of, or with the addition of life insurance, in which you can create generational wealth. You just need the assistance of someone who understands them and who can establish certain I don't want to say methods, but certain investments to ensure that whatever goes into the trust as a form of life insurance money will be invested well.
Well, no, I think, Mr. Obakeng, from my side, that is it for the day. Thank you so much for your time. I'd like to believe everyone who's watching, who's watched all the 3 episodes, gained a lot of insight. Thank you for your knowledge, your expertise. I even, there were moments, and I'm sure you'll see them on camera, where I was also, you catch me off guard, so I also learned quite a lot. So yeah, I think with that being said, all I'm just like to say is thank you. Thank you for your time, and thank you for coming to the School of Finance.
Thank you for having me.
Yeah. Ladies and gents, that will be it. But like you guys heard, we spoke about pension, provident funds, retirement annuities. We spoke about business insurance, keyman insurance. Then obviously we ended lastly with of course, life insurance as well as trusts. So I think just to summarize everything, as you guys have heard, protect yourself, set up proper retirement annuities and plans, protect your family, by giving them a future, by setting them up with a beautiful life insurance and setting them up with a trust. I hope you guys have learned quite a lot, as I did. And yeah, thank you for tuning in. Guys, please do help us grow the page. So please like, share, comment, and of course, subscribe. Thank you.